Hello, Dave Boucher here. What I'm going to show today is basic inventory production analysis presentation based off of a company we're doing venture work for. Basically, the food manufacturer company selling different types of food products, and they're being manufactured in different plants, both in locally and overseas. So basically, I had to put together a sales forecast to see if it's a worthwhile investment for the venture, and also a production, and to see the inventory, what inventory levels they have, and what kind of production costs they're doing, and different formulas that we're using to produce all these numbers here. So basically, let's start out with the sales forecast page. Shows on the left here is the yearly forecast, and then each of these other columns are the quarterly. So to put together the sales forecast, we got GDP, seasonal factors, price change, advertising, salary, model, if there's model changes, to get the total actual expected sales revenue total itself. So for the GDP itself, the GDP change, as I said, this is the yearly total, and then these are the quarter. But to put all the numbers together, we did a seasonal forecast formula that multiplies this average seasonal factor times the salespeople, the salesmen themselves, as for each quarter, as they change, come and go. So as these salespeople change, these numbers here also change, and it affects the yearly output. So basically, most all these numbers are changed for this presentation purposes. So I just want to show you here, if I put in 3, they have 3 salesmen, this number over here obviously changes, so expected sales forecast and the revenue obviously changes. So basically, the seasonal factor is an important point right here, this 24, and also this price change here. There is different prices for each of the different areas in different regions that we're selling, as do advertising, salary, commissions, so on. So to get this number, this expected sales revenue number, 11492, which is in thousands, each quarter we put together a real GDP and a CPI, which is the Consumer Price Index, or inflation number, for the previous and the future. So we wanted to get a CPI change on a percentage-wise. We also had to get a forecasted, a future forecasted real GDP, and you get that out of most newspapers, and we put together to find the formula itself, and also to get a real GDP number elasticity to properly put the formulas together. Now, price change, we also wanted to put together a price elasticity to see what each area was going to be changing in historically and future, along with advertising elasticity. Now, in the future quarters, we also did real GDP forecasted out based off of what we were then getting as you go along to change it, and also to get this real GDP elasticity number. So next, we had to find a production. So what this showing is a production plan worksheet. So to know what inventory you're going to make or produce for each plant, obviously you had to get those sub-forecast units. And we put together a safety stock, which is safety stock number. We just, on this presentation, I put in, the 15%. You can do that based off of whatever the company wants, so it doesn't run out of the product itself. And then, your beginning inventory, sales, office orders, what you're going to be ordering, your purchases, your shortages, and then we had a good number of affiliates in the historical purposes and sales to affiliates. So the models for this had several different types of food products itself. So for this presentation, we didn't have any sales to liquidators in the previous year, but they have quite a few liquidating out for different product change. So then you get your inventory number here after you put all these numbers together. Now, production cost analysis is an important point because you have to put together your labor and depreciation or your plant depreciation, whatever your equipment is, to get your total production cost values in thousands. And we wanted to put together that to see the labor plus materials costs minus this plant depreciation cost to get a certain value, which you can see up here, to use it as our cost multiplier to see what our cost savings are going to be, or in this case, our comparison of the home plants versus the overseas plant. And as you can see here, the overseas plant ended up being, with the multiplier, ended up being a little bit less than actually quite less than the home plants. So it ends up being our net savings per unit with this plant is 1.38, but our max total savings with the overseas plant is 273, and that's the dollar value in thousands, which is the number is more relevant. But for the next 4 quarters itself, it's going to be over 1 million. So that is quite a lot of cost savings, which was good to view on the long-term basis of this company. Now, we also wanted to better explain a little bit about how some of those formulas are put together. We used industry unit volume forecast, putting the quarter numbers together, and the share of market, what the food compared with other companies, competition, and a percentage basis, along with unit volume. This is both industry unit volume and company unit volume. And the price gain, the price change, was also pretty big price changes for each area themselves. So regions or divisions had different prices for the types of crude based off of a historical average forecast inflation gain. And you put some of these numbers together to get these forecast values, using the statistics, R squared, or different type of standard deviations also, to get a certain precise value. I guess I should say more precise value. So the quantitative numbers, looking at each product itself, say we have a 1783 on hand, the average cost is 12, or 0.12 I should say, to get your asset value of 213. Well, the percentage of total assets, putting that together on this product itself is 8.1, with sales price 0.15, so your actual retail value of that product is 267. Now, when you look at a large size product, you look down here, well, this is $3 million for the retail value, and it has a 37% percentage of total assets. So when you look at that asset value, you see that the average cost, that's the important point, is the cost, because you want to lower that or raise that. That's quite big, because it is quite big product, quite large, heavy, hard to produce type of food at 53 at an average cost. But overall, you end up having that cost savings of 1 million. So your inventory valuation summary is based off that sales price is a decent sell. Thanks for the attention of this presentation.